This story is a powerful reminder of how one small accounting error can change the course of a business owner's life. It's the real case of Mostafa Abbass versus the King. It's a 2023 Tax Court of Canada decision, where a single line on a tax form entered years earlier led the CRA to reassess an already closed year, add 92,000 of supposed income, and impose penalties for gross negligence. What began as a routine audit turned into a years-long battle, all because of a bookkeeping mistake. Hi, I'm Amandeep Singh from Cloudriver CPAs Inc. here in Burnaby. Think of us as your Google Maps for tax, helping business owners stay on track and avoid the wrong turns that lead to CRA disputes. Here's how it all began. Mr. Abbass came to Canada from Iraq in the early 1990s. He had only a grade 5 education and had spent his working life in manual labor. Like many newcomers, he faced significant language barriers. Understanding only a small fraction of spoken or written English or French. Still, he was determined to build something of his own. In 2008, he opened a small grocery store in Montreal that sold everyday items and products from the Middle East. He worked tirelessly to keep it running, often with the help of his wife and children. His teenage son helped stock shelves after school, and his daughter translated documents and letters from suppliers and government offices. Because of his limited language skills, Mr. Abbass relied heavily on an outside accountant to prepare his corporate and personal tax filings. Each year, he would sign the forms, brought them to the accountant, trusting that they were completed correctly. Several years later, the CRA audited his corporation for the 2013 and 2014 tax years. The auditors found some unreported sales at the corporate level. Relatively small adjustments of about 32,000 for 2013 and 17,000 for 2014. But during the review, they noticed something on an older tax return, a 2010 balance sheet showing a due to shareholder balance of $92,000. That single entry became the spark for a much larger issue. The CRA assumed that Mr. Abbass had personally loaned $92,000 to the company, which meant he must have earned that amount somewhere and failed to report it as income. Although 2010 was already beyond the normal reassessment period, the CRA invoked subsection 152(4)(a) of the Income Tax Act, claiming that there had been a misrepresentation due to neglect or carelessness. They reassessed his 2010 personal return, added $92,000 to his income, and imposed a gross negligence penalty under section 163(2). But when the case reached the Tax Court of Canada, the story began to unravel. The CRA auditor, Mrs. Chow, admitted under oath that she had never actually audited the 2010 year. She confirmed there was no proof, no deposits, no withdrawals, and no bank records showing that Mr. Abbass had ever transferred that amount. The CRA's entire conclusion rested on that single line from the corporate Schedule 100 form of the T2 return, corporate tax return. Then came testimony from Mr. Abbass's accountant. He acknowledged that the entry was his own error, a simple bookkeeping misclassification. He had mistakenly placed supplier balances under due to shareholder instead of long-term debt. It wasn't a loan from the owner at all. It was an amount owed to vendors. He took full responsibility for the mistake and explained that Mr. Abbass had very limited ability to review or understand such documents. You see, the court also heard from Mr. Abbass's children. His daughter and son, who were teenagers at that time, described their family's modest finances and testified that their father simply did not have such money to lend. Their testimony matched the evidence. The household income was low, and the CRA's own net worth test had shown that their lifestyle was consistent with their declared income. So Justice Jean Mark Kenyon weighed all of the evidence carefully. To reopen a statute-barred year, the CRA needed to prove two things: that misrepresentation existed in the original filing and that it was caused by neglect or carelessness. But there was no proof of either. The CRA had not shown any undeclared income, and the so-called loan was nothing more than a misposted accounting entry. The court ruled that the reassessment was invalid because the 2010 year was a statute-barred year. The penalties were cancelled and the appeal was allowed with costs. After nearly a decade of uncertainty, finally, Mr. Abbass was cleared. This case holds several lessons for a lot of business owners. First, once a tax year is statute-barred, the CRA can only reopen if there is concrete evidence of the misrepresentation, not just a hunch or a spreadsheet error. Second, even small bookkeeping mistakes can have enormous consequences. You see, a single wrong line can lead to years of correspondence, stress, and legal expense. Third, when a bookkeeper finishes recording your transaction, it's wise to have a CPA, a professional, provide a second review before filing the T2 corporate tax return. A CPA adds a compliance lens, ensuring that shareholder loans, supplier balances, and other accounts are properly classified and that the financial statements align with CRA reporting requirements. That professional oversight is often the difference between a routine filing and a costly reassessment later on. Now, at Cloudiver CPAs Inc., our focus is primarily on corporate taxation. We help small business owners ensure that their filings are clear, accurate, and supported by evidence that makes sense for both the client and the CRA. A few extra hours of review today can prevent years of stress tomorrow. The court's decision in Abbass versus the King is a reminder that numbers tell stories, but those stories must match reality. When they do, taxpayers stand on solid ground. Thanks for watching, and I'll see you in my next video. Until then, bye.